Welcome to CFP Exam Prep. Today we're diving deep into qualified retirement plans, a crucial topic that frequently appears on the CFP exam. Let's break down the essential concepts that will help you navigate through complex questions. Let's start with the fundamental concept of qualified plans. These are employer-sponsored retirement plans that meet specific Internal Revenue Code requirements and offer tax advantages to both employers and employees. The tax treatment is straightforward. Contributions are tax-deductible for employers, and employees enjoy tax-deferred growth until distribution. A common mistake students make on the exam is confusing pension plans with profit-sharing plans. Pension plans are defined benefit plans that promise a specific retirement benefit based on a formula considering years of service and salary history. The employer bears the investment risk and must ensure sufficient funding to meet future obligations. For example, if a plan promises 2% of final average salary times years of service, an employee with 30 years and a final average salary of $100,000 would receive $60,000 annually in retirement. Profit-sharing plans, on the other hand, are defined contribution plans where the employer contribution varies based on company profitability. The key difference is that there's no promised benefit. The maximum employer contribution is 25% of eligible compensation, not exceeding $66,000 for 2023. Many students forget this limit on the exam. 401k plans deserve special attention as they're frequently tested. These are defined contribution plans allowing employee salary deferrals. The 2023 employee contribution limit is $22,500, with an additional $7,500 catch-up contribution for those 50 and older. A critical exam concept is understanding discrimination testing. Highly compensated employees' contributions may be limited if lower-paid employees don't participate sufficiently. Employee stock ownership plans, or ESOPs, are often misunderstood. These qualified plans invest primarily in employer stock and can serve multiple purposes. Beyond retirement benefits, they're valuable tools for business succession planning. The exam often tests scenarios where a business owner uses an ESOP to transition ownership while creating retirement benefits for employees. Cash balance plans represent a hybrid approach, combining features of both defined benefit and defined contribution plans. They express benefits as account balances, but guarantee a specific return, typically 4 to 5%. A typical formula might credit 5% of salary plus 5% interest annually. Students often miss that despite looking like individual accounts. These are actually defined benefit plans for funding and regulatory purposes. When tackling exam questions about qualified plans, watch for vesting schedules. Many students overlook the significance of different vesting rules. Cliff vesting must occur within 3 years for employer contributions, while graded vesting must complete within 6 years. Employee contributions and safe harbor matching contributions are always 100% vested. Remember these key testing points. Qualified plans must cover a broad group of employees, not just owners and executives. Benefits must be reasonably comparable across employee groups. There are strict rules about when distributions can begin, typically age 59.5 to avoid penalties, with required minimum distributions starting at age 73. The most successful exam takers understand not just the rules, but how these plans work together in practice. For example, a small business might combine a cash balance plan with a 401k to maximize tax-advantaged retirement savings for owners while providing meaningful benefits to employees. Understanding these practical applications will help you tackle the more complex scenario-based questions on the exam.